The policy guide that we've drafted was enabled by, first of all, DFID's interest in protecting the poorest and most vulnerable people from global shocks. This was an interest which emerged in the wake of the financial crisis. So in a sense, the question that we were trying to wrestle with in getting to this, in writing this guide, was the extent to which, particularly savings and insurance, would enable the poorest people to be protected in that way. And this is part of ODI's Shockwatch project, which I'm sure you'll find on the ODI website. There's other aspects of the work, looking at food prices, looking at wages, rural wages in particular, looking at protecting growth patterns and so on. We were also enabled to do this by MasterCard, the MasterCard Foundation's interest in getting the poorest people into financial services to the extent that they want to be there. And obviously from what's gone before, that is a tremendous challenge. So that's the challenge that the policy guide seeks to address. And our policy guides try to provide advice that is as practical as possible to policymakers and practitioners. It doesn't deal with credit because we felt there was a very large literature out there on credit. We've just heard from BRAC on this. And the literature that is there, there have been now successive reviews of the extent to which the poorest people are involved beneficially in microcredit and credit more generally. And at best, there are mixed results. So we felt that perhaps looking at savings and then more innovatively at insurance might provide more promising avenues for the future. And we've identified 4 promising directions. Lucy is going to talk about the first 2, which is linking informal savings clubs and groups with formal financial services. And secondly, linking financial services with social protection. This has already come up briefly in what William said. And then William's going to talk about the other 2, which is scaling up weather-indexed insurance using lessons from existing pilots. And finally, expanding mobile money. I guess a lot of this discussion is around mobile money, very fast-moving area, but also looking at deepening financial inclusion through mobile systems. This is still a draft policy guide. You should all have had an electronic copy. We aim to publish it by the end of the month. So if you have comments on it, please do let us know either today or by email afterwards. Thank you. I'll turn over to Lucy.
Thanks for the introduction, Angie. So this is just a quick overview of the presentation. Start with discussing the current inclusion of poor people and then make the links between poverty dynamics and financial services. As Andrew mentioned, a key driver of this work was to look at the extent to which financial services can prevent impoverishment, and then go on to look at the 4 key areas which we picked out in the guide. So I guess the overall argument which William spelt out initially is, that access to financial service is argued to enable consumption smoothing and can increase investments in health, education, and also income-generating activities. And so the argument is that financial services can at least play a role in breaking the cycle of poverty. So this guide is specifically focusing on savings and insurance, and particular tools which may be able to promote greater inclusion in savings and insurance. So that includes mobile money and also having a bank account as a kind of entry point into full and more kind of comprehensive financial inclusion. So if we look quickly at the kind of current financial behaviour of poor people, so it could be assumed that poor people live from hand to mouth. They don't actively manage their finances, don't plan for the future. But I mean, as is now we're increasingly aware through particularly detailed financial diary research, is that poor people do actively manage their money to meet their needs. Then the short and medium terms, they put aside money to save for the future, to kind of help to buffer against the future role of shocks, such as, say, having ill health in the family. So you would expect that there is at least latent demand for certain types of financial product, because frequently what you see is that poor people don't have access to formal financial services. The Global Findex database shows that just 23% of adults living on less than $2 a day have an account at a formal financial institution. So what this does mean is that poor people are frequently having to manage their money in other means, so which are perhaps less than perfect. So saving money under a mattress, which comes with risks of theft, or using informal savings clubs. And meanwhile, use and access to formal financial services is more concentrated among the more wealthy quintiles of the population. So these next two graphs just illustrate these points in two countries, in Uganda and Nigeria. So the graphs look at consumption quintiles. So this should just note actually that these for Uganda and Nigeria, this data comes from household surveys, which are nationally representative, and the aim of them is ultimately to assess people's welfare rather than just to focus on financial services as such. So they do have limitations. And they also focus at the household level, so that doesn't highlight disparities necessarily within a household in terms of access and use to financial services. But what these graphs do quite clearly show is, so this one for Uganda, so among households which have a savings account, the majority of those are in the richest quintile. Meanwhile, in the poorest quintile are more represented in use of informal savings clubs. And in terms of insurance, that's among households which have insurance, that is very much concentrated in the richest quintile of households. And so for Nigeria, there's a kind of similar situation. Again, this graph is structured slightly differently. So you've got the 5 consumption quintiles across the bottom. And then the orange bar shows in those consumption quintiles what percentage have a bank account, which again is much highest, almost 70% in the richest quintile compared to under 10% in the poorest quintile. And meanwhile, informal savings groups, which are the red bar, they're much more prominent, again, among the poorest quintile in relation to other forms of financial service. But interestingly, across all wealth quintiles, households are still using informal savings groups, which perhaps you would expect to shift away from those. So what we also wanted to do for this guide is to investigate more the relationship between poverty dynamics, or movements out of poverty, falls into poverty, or kind of people being stuck in poverty, and access or use of particular forms of financial service. So out there in the literature, there's evidence from very specific randomized control trials about the benefits of particular forms of insurance and savings for escaping poverty. So, for instance, in Ghana, there's evidence that index-based weather insurance can lead to positive outcomes for farmers, since it provides with the security to make the shift from subsistence crops and over to more risky cash crops. And then also in Kenya, another randomized control trial shows that after households take up a commitment savings service, particularly female market vendors, once they take up this product, they're able to mitigate the effects of health shocks and also able to improve their expenditure. So it has a kind of double effect there. But for this guide, we thought we'd look more generally at the relationship between poverty dynamics and access or use of certain services. So we analysed the same national level household panel data as was shown in the previous graphs. And this panel data returns to the same households at 2 points in time. So you can tell what their situation was like at the first round, and then compare it to the second round and what's happened in terms of their poverty status. And so this graph is for Uganda. So households which remained in the poorest quintile, they're the purple bar. Again, you can see that their access is, in general, or their use is less than households which escaped or fell in, and certainly less than households which stay out of the poorest quintile. I should state here that we didn't investigate causality in this relationship, so this is more giving an indication of the relationship, but it could be, for instance, that households which are escaping poverty, as you can see, that's the orange bar, they have high use of informal savings groups. That could either be a consequence of becoming more richer, they're more likely to save in savings groups, or it could be because of the services which a savings group provides, they're able to improve their situation. So the direction of the relationship we haven't explored. But again, for Nigeria, this is the same graph. It shows a reasonably similar situation. This is between 2010 and 2012. Insurance is very low among households certainly among households which stayed in the poorest quintile and among those which moved in and out. And it's still only 5% for households which remained out of the poorest quintile between that 2-year period. I guess in terms of the chronically poor, people which remained in poverty for 2 rounds, again, informal savings groups are the most predominant kind of form of financial service use that is recorded in these surveys. So the first, I guess, don't want to call them golden bullet, the first promising avenue we looked at for improving financial inclusion for the poorest people is linking informal savings groups with formal financial inclusion, with formal financial services. And as we just saw from the previous graphs, poor people are most frequently involved in informal savings groups, which kind of have the advantage of being close by, they're low cost, and through a certain amount of peer pressure, they can enforce savings discipline. But they have limitations, including the risk of theft from lock boxes. Members can't save enough for bulky purchases in one savings and loan cycle, so you have to wait over time in order to be able to take a big enough amount of money in order to make a bulky purchase. And also, in the case of covariant shocks, when all members of the group are potentially hit, such as by a flood or drought, there's then limitations on the supply and demand into that group. Meanwhile, savings groups often can accumulate a high level of deposits. So it could be that those significant deposits could be attractive for financial service providers, and it could also help them to bring new clients into their fold. So intuitively, it seems that there is potential from combining informal savings groups with formal financial services. I guess the biggest effort to do this has been in India through self-help groups, which are linked to banks, mainly with the aim of providing credit to the self-help groups. There are a few evaluations of self-help groups, and they do suggest that in general it's positive in terms of improving members' socioeconomic condition and skills. But also there is some evidence that the impact is greatest if you have external NGOs, say, facilitating the groups and supporting them over time, which, if you're looking at scaling up a successful model, could pose a constraint. Another approach to linking savings groups with formal services is CARE's approach with its village savings and loans associations, particularly in East Africa. And here this is a slightly different model because they put much more an emphasis on the formal financial service providing a safe place to save. So saving is very much the driver rather than credit. And so they're looking more for mature groups to then link with financial service providers. So there's less pressure on them, say, to take credit, which might be unsustainable. So I guess we looked into this in some detail, and while we thought there's intuitive appeal of this linkage approach, there is currently very little evidence. It's still kind of a reasonably new, untried and untested approach. And certainly in terms of the poorest people, how they could be properly kind of involved and empowered through this approach rather than just being taken along by other members of a group, say, is something which would need to be investigated. The second area we looked at was linking social protection payments to financial inclusion. So we kind of thought that there are 2 ways through which the two can be linked. So there's kind of an add-on approach, if you like, which would be, say, making transfers conditional on savings behaviour or conditional on taking out insurance, or you had to, say, form a savings group in order to receive the transfer. Or the other approach is a more add-in approach to enable savings, which would be the digital transfer of benefits to beneficiaries. And so But I guess there is a kind of tension here between, well, it intuitively again seems a very attractive approach. There is a potential tension between the immediate objective of social protection, which is to help support people's consumption and play a preventative role in the face of shocks, and the financial inclusion agenda, which potentially could be more long-term, particularly if you're setting up digital payment systems, the time required to set them up. And should you really be enforcing compulsory savings, say, on very poor people with the immediate cash transfer payment? So there are some kind of tensions there. But just quickly looking a bit more about the digital transfer of social protection payments, there are big opportunities here. They can reduce costs and travel time for beneficiaries and increase the convenience for them to pick up their benefits. Particularly if they enable greater flexibility in when you pick up your benefits. That can really reduce time spent queuing, say, to pick up on a particular collection day. On the other side, they can also provide incentives for providers to reach the poorest because they receive a regular fee from government to deliver the transfer, which they could use to, say, expand their agent network into more remote rural areas which have previously been unattractive. And also for governments, after the initial setup costs, the recurrent costs are lower in terms of delivering the payments. But I mean, that's obviously there's big challenges here. There is the initial infrastructure development. How are the costs borne? And maybe quite fundamental stuff like mobile phone masts in locations. If you're thinking of delivering through mobile payments, kind of how is the cost structured around those? There's also issues around agent liquidity, which currently most beneficiaries, as soon as they receive their payment, they go and they withdraw it straight away, which has challenges for agents in terms of having enough cash available on a particular day. Part of this is because beneficiaries in some programs believe that they'll lose some of their payments if they don't withdraw it straight away, because it shows they don't have an immediate need for it. So part of the challenge is educating beneficiaries around the fact that they don't have to make immediate withdrawals. Another challenge is around the costs for the financial service provider, who often don't necessarily understand, or there's no knowledge about the future kind of profitability of beneficiaries if you offer them a total bank account with which they can do all the transactions and they want in. And so financial service providers often want to provide a kind of closed service, so restrictions on withdrawals and stuff for beneficiaries, which can have implications for kind of genuine financial inclusion in the future if they're locked into a more closed system. So if I pass over to William for the next stages.
Thanks. Just a couple of minutes on to the last two topics which we covered. The first one is about index-based weather insurance. Now, as you saw, and it's clear that access to insurance for the very poor is very low at the moment. And agricultural insurance in general, traditional agricultural insurance has failed in developing countries pretty comprehensively. So there's a lot of interest and hope in the potential of this index-based weather insurance, which in a nutshell means that when somebody buys insurance and the event happens, instead of an insurance assessor coming along and seeing how much the insured person has lost, the payout is triggered rather by an objective index or being reached. So, for example, based on rainfall in a rainfall gauge, that if rainfall at a particular period of time in an agricultural cycle has been under a certain threshold, then a payout will be made automatically without any assessment of damage, but based on prior experience to see that if rainfall in that area goes below a certain level at a certain cycle of the crop, then what is the likely impact, what is the historical impact on yields. So it's a way of trying to make insurance transactions, the payout of insurance, a lot simpler and cheaper. And there are a number of reasons why this system of index-based insurance was believed. It's not just for drought, but also for flood and other perils. But there are a number of reasons why people felt that this was a very high potential for bringing the cost of providing insurance down and therefore being able to include a lot more poorer people in insurance schemes. One of them is the fact it's just the cost of doing it. You don't have to send an assessor out. You just look at the rain gauge, or you look at the satellite image of vegetation in a dry area. You don't have to go and assess individual farmers. Second is that people can't rig it. That if the rain gauge says the rain was that amount, then there is no moral hazard. People can't, for example, neglect their animals or crops and say, oh, well, actually, the drought was very bad. Please pay out your insurance policy. So the moral hazard is removed. Adverse selection is improved because preparing these products, insurance companies look very carefully at what are the likely impacts of certain index thresholds being reached. So people who are in risky areas can't have better knowledge about the likelihood of them receiving insurance payout, which is oftentimes with traditional insurance, people who are in higher risk areas are much more likely to buy the insurance than people who are not. And lastly, because of these advantages, the index insurance schemes often are able to access reinsurance at a much lower cost. So there are a number of, this is a really nutshell, but a number of reasons why people were very hopeful that index-based insurance could reduce the cost, make it simpler, and thereby allow insurance companies to do it more profitably with small farmers. Looking at the evidence that we've gone through, there appear to be a number of challenges. One is that index insurance only works for single perils. So if you're a farmer, you can have an index insurance against drought, but then if pests come along, you're not insured. So because that's not part of the index. So there are drawbacks in terms of what is insurable under these schemes. Second is you need good data. You need to have decent weather systems. You need to have satellite images of vegetation, etc. Third is basis risk. Basically, that insurance companies have done the calculation. If rainfall is at a certain level, we assume that there will be a loss, but in practice, sometimes those calculations are not fully accurate. Some people may receive a payment because the water gauge said there wasn't much rain, but their crops were fine because of microclimates and other reasons. So there are a number of sort of structural issues that need to be dealt with in the design of these products, which are pretty difficult. Lastly, distributing these kind of insurance products and explaining them to poor people who are not used to insurance in the first place can be quite hard. If you tell them, well, in this distant weather station, if that recording is between 10 and 20 millimeters at this time of year, you'll receive money, and if it's not, then you won't. These kind of concepts have been quite hard to sell to people, and to actually access large numbers of smallholders and distribute these products is pretty hard. So a lot of pilots have been implemented. There's one very, very large scheme in India, which is heavily government subsidized. But in terms of commercially viable products, it's been pretty limited to date at the sort of at a pilot stage. So even though there's a lot of promise, I think there's also in practice been a lot of problems. And the question is how to use the advantages of index insurance to have a wider impact on poorer people. And we just came out with a number of ideas. They're based on things that have actually happened, but some of them are basically what they do is most of them avoid the problem of trying to convince and sell to lots and lots of small farmers. So there have been cases where this kind of insurance has been sold to governments. So for example, in Mexico, it's the Mexican government pays out to farmers if the maize yield fails. Where do they get the money from? In Mexico, they've set up a system whereby provincial governments will buy index-based insurance so that if a harvest failure occurs in maize and now in other crops, they will receive a payment from the insurance company, and that is used to finance government payments to farmers in the case of catastrophic losses to drought. So selling the product to governments as opposed to individual poor households is one area which has been it's also been used in Mongolia for livestock deaths and payouts made by the Mongolian government to herders in the circumstances of very cold weather. Second, another way of using the technology, if you like, without selling to individual households has been to aggregators. So that means selling policies to those companies or institutions that serve low-income markets. That might be microfinance institutions or banks. So, for example, this is a very interesting one in Peru, where there has been a product which pays out when floods occur as a result of El Nino, and that product has been sold to a number of banks in Peru. What's interesting about this one in particular is that it's based on sea temperature rises. The index is sea temperature rise, which is a predictor of El Nino floods in Peru. And that means when the temperature in the sea rises, the payout actually is made to those companies that are insured before the event happens. So they actually receive the money before the flood happens. So that, I think it's the only one in the world to do that. But the point here is that it's sold to banks rather than to individual households. There's talk about coverage of groups. I won't go into that. Funeral clubs in Ethiopia perhaps being sold index-based insurance. And if we're talking about continuing to try and sell index insurance to very poor people, then obviously, as we've talked about, there have been some models of using mobile money as a way of getting people to pay for it, distributing it through the same channels as mobile money through other aggregators. So those are some of the opportunities that we think should be borne in mind when some of the pilots for index insurance appear not to have worked in many cases, but there is potential through some of these larger scale initiatives to have a wider impact. Just lastly, it's mobile money. I put up a whole load of figures here, which I won't go into in detail, but it just shows you the growth in mobile money globally. These are 2014 figures. The report that was circulated said 2013. But it basically shows you that there are 300 million mobile money account holders now worldwide. Slight problem with inactivity, as in bank accounts that we just discussed earlier. Only about a third of mobile money accounts are actually active, but still 100 million accounts globally. Vast growth, 75 million new accounts opened last year alone. Well, I think one of the statistics which is really interesting is that in 16 countries now there are more people have mobile money accounts than bank accounts, and that number is increasing every year. So the potential of a technology which only really was launched in 2008 already to overtake banking in terms of numbers of accounts in those countries, I think is quite significant. What we see at the moment also is that even though there is massive growth, very rapid growth, but if you look at the numbers of people who actually have a mobile phone, only about 8% of them have a mobile money account. In East Africa, that's much, much higher. In fact, in Africa in general, it's higher at 23%. But there is still a potential market of people who use mobile phones out there who haven't used mobile money yet. Most transactions still are person-to-person transfers or buying airtime. There's excitement about international remittances through mobile money, and at the moment that's tiny. It's about 0.1% of all transactions. But that's the largest growth, even though it's tiny, it was the largest growth in the type of transaction was in international remittances last year, primarily in West Africa as a result of where it's slightly easier because people use the same currency. I think West African franc, is it, or something like that? Anyway, yeah. Okay. So that's the potential. I won't go into what the impact of mobile money has been, but again, just highlighted a few opportunities about how mobile money can, we think, could start to build financial inclusion of the poorest. We talked about some of them already, so I won't go into linkage with savings groups, digital payments for government social protection schemes. But I think on a wider level, what is clear from what I mentioned earlier is there are all kinds of regulatory obstacles to actually growing the system in general. So there are some countries where it really hasn't grown yet, for example, in India. So, some of the work on spreading out mobile money to poor people is about those regulatory obstacles to rolling out the system in certain countries like India. And secondly, where the systems have been rolled out, and I think it's 89 countries so far where it has, with I think 50 odd countries where there are at least two mobile money operators competing with each other. In those countries, there are obviously obstacles about inclusion of poorest people, and that's to do with things like signal coverage in remote areas, also financial education, people having difficulty with English menus on the mobile phone. A lot of interest now in voice-activated user interface, which I think people believe may widen access to lower income groups. So in addition to those specific mechanisms we talked about, I think that there are system-wide opportunities also for trying to widen the use of mobile money for those particularly excluded low-income groups. So that wraps up the mobile money.
William, thank you. That's an incredible amount of food for discussion
Right,
there. Two thoughts just to kick things off. I mean, the mobile money story I think is a really interesting one because if you look at the variation between access to mobiles and access to financial services, that if you take Kenya as a sort of outlier, it's almost one-on-one. In other words, you get very high levels of coverage of mobile and very high levels of coverage of financial services linked to that. There are many other countries with equivalently high levels of mobile coverage, but India is a standout example, but very low levels of financial service coverage. So that, to me, that really brings this issue of financial regulation and banking regulation, because there are quite big vested interests actually in the banking sector. I mean, it happened in Kenya for very distinctive political reasons. So I think understanding the political obstacles is a really important part of the story. The second thing I was very struck by from all the presentations actually was the savings story, because if you look, I think there's a misperception that poor rural people don't save, and actually they save like hell to self-insure against risk. And it's actually the most cost ineffective. So not only do you face the highest risks, but you pay the highest premium, if you like, through the most efficient mechanism, through self-insurance. And it strikes me there that the twin challenge, it's partly a financial service one. Like it's how do you channel resources into pooled risk mechanisms that can lower the cost, but it's also a question of how do you lower the background risk, which is to do with infrastructure investment and social protection and many other issues. So, look, let's. What I'm going to do, I was going to throw it open for discussion. Remember, Maria, we still have you, don't we, online? Maria? No. Can you? Can we check what's happened to her? Oh, great, you're there. Good. Okay, so look, let's if there are any specific questions on Bangladesh, put them to Maria, but more broadly on the presentations, please.